All right, so basically I've been learning a few things from my cousin back up in the Natty. And he's been teaching me some things. So basically what I did in a nutshell is I basically mark up everything from the 15-minute to the 4-hour. Just basic market structure off of imbalance structure. I'm gonna kind of go into that. Excuse me.
So you decided to jump from 15 minutes to another 3.5 hours.
Say it again.
So you went from doing 15 minutes to a whole 4 hours.
Well, instead of starting from the daily to the 15-minute, I started on the 15-minute and work my way to the 4-hour and just mark up. That way, when I hit the 15-minute, I get an idea of what price is doing against that structure. Then I look for imbalances. I'm going to kind of go into that, how that works. And then, of course, I use the Delorean Ema as extra confirmation. So sometimes we go back 6 months, and what that means is we go back as far as we can until TradingView doesn't record any more price action data. So we can see this is where it ends here. So this is where I actually put my horizontal line. So now what I typically do is I start marking up basic market structure. So I based it off of, imbalances, and imbalances is when you actually see moves like this, right? When price shoot down very hard or it shoots up very hard. All right. So that's why I base my market structure off of that, because then that's where you're going to get the most consistent trades when you're trading off of institutional imbalances. So I want to kind of explain that in a minute. So this is yellow. So I'm going to change this to yellow. And I'm going to start marking up everything. All right. So we got that marked up. Let's see. Okay. So marking up basic market structure here. Yeah, this is a good one. Because I could do it like this. Yeah. And then once I do that, and that's when I draw my supply demand zones. Change the coordinates to everything. So it's kind of similar to what I was doing before, but I do it in a lot of different fashion. Actually, this is supposed to be yellow. Yeah, I could put one up in this area. Change the coordinates to these. All right, so we got everything marked up on the 15 minutes, and now we're gonna go to the 30-minute. Now we're gonna start up here. So I'm gonna put a vertical line. And this is gonna actually represent, all this here is gonna represent the 30-minute time frame market structure. So the reason why we do this is because when we get an idea of what price is doing in the past, we'll kind of understand what's going to do in the future. So what's up?
You just create yourself a spider web.
Is that a spider web?
Yeah.
Yeah, I mean, you know,
I mean, it's kind of like, you know, when a spider web, when an insect hits the web, it vibrates, right?
Yeah.
Same thing with your chart.
Exactly. Exactly. You know, you get an idea of where price is vibrating against the market structure. Yeah.
Yep. It's funny how every insect and animal's mobility is used into technology.
Oh yeah. Oh yeah. Oh yeah. You already know. We know who creates these things, so it's no surprise. So strong up market structure. This is a good area too as well. All right, so now I'm going to change the coordinates to these. All right. So now we marked up to 30 minutes. We're going to move on to the 1 hour. All right. So this is all 30-minute and 15-minute marked up. So now we're going to move on to the 1 hour here. I'll make this red.
Wondering about this? We need when you look at the price. All this opportunity. That's going to see. Following you here, little notice. Well, family, friends, sleeping getting on with the network. No longer a part of this organization. Since when? It's decided to move that to his head. It's my car. Oh my God. Feel me. What the hell happened? Personal matter. What? Vladimir entered exactly like part of that. The masked vigilante killed his brother.
We'll change all this.
Only.
So now we did all that. So we're going to switch on to the 4 hour. So now we see we marked up everything from the 15-minute to 1 hour. Now we're going to do the 4 hours. So we see at this point on the RSI, price was pretty much overbought. So it's understandable to put horizontal line here and then draw a zone here. And then really the same thing right here as well.
I'm going to sketch the three of you. I like my head where it's at. Then we're in agreement. Nothing changes until I'm ready to move on Vlad. And what if he finds out the truth before that happens? What's next? Which around these crazy Russians, putting my stun gun out of storage.
All right, so we marked up everything all the way to the 4 hour. Now we're going to go back to the 15-minute. And so as you can see on the 15-minute, we drew these zones perfectly because price interacted with this zone, which made price shoot on down. So this was a valid liquidity area in order block. Same thing down here, which made price go up and ultimately go up to here. So now we completed step one. So then the very next thing I like to do is I like to look at current price and ask myself, okay, is price trending upward, or is it trending downward, or is it consolidating? Okay, now we see that price did a huge imbalance impulsive move here and then took another impulsive move up, but then it consolidated. But then it looks like it's breaking out. But to me, honestly, this is consolidation to me. So matter of fact, price was actually all the way up to this point here when I got in. So at this point, we see that price is clearly consolidating. I'll even zoom in. So let me pull this down. So at this point, shoot, you know what? I'll just do it that way. So we see that price is consolidating. So this is my rule when it comes to consolidation. I don't trade it. I want to wait for a breakout. So now the second thing I want to do is now to identify the trend and price is consolidating at this point. So then what I like to do is locate imbalances. Now, the first thing I do before I do that is I turn on my higher high and lower low strategy indicator. And so basically I like to place horizontal lines on the most recent high, which we can see it all the way up in here, and then the most recent low. Now, the reason why I do that is for the simple fact because I want to see which way price is going to break out first before I make my move. Because that way I can wait for price to come to me. When it comes to consolidation, you want to wait for a breakout.
Yeah.
So now I turn this off. Then my very next step is, and I'm actually going to write this out real quick here. Write it out here. Step one, mark up zones from 15-minute time frame to the 4-hour. Number two, identify a trend, which we did. So now we're on 3. Locate institutional imbalances in the market and use that to figure out which imbalance the banks will fill next. And number 4, plan our trade and price breaks and retest for a buy or sell. And number 5, wait a minute. Locate institutional imbalance. Okay. Number 5, then use the Delorean Ema cross to extra confirm and entry. And then 6, execute trade, then close partials. On goal. Excuse me.
Yeah.
Excuse me. All right, so I'm going to stretch this out here. So we already did, shoot, I accidentally spelled a word wrong in here. There we go. So the first thing we did was we marked up zones from the 15-minute to the 4-hour, and then we also identified the trend. Now we're going to locate institutional imbalances. Now I'm going to turn on my order block indicator, and this is the indicator that I spent a one-time $7 for. What it does is it helps you to locate order blocks and imbalances. Now, let me explain what imbalances are. So these are imbalanced candles. So when the banks are trading in the market, they are pretty much the main big whales in the market that forces price to sometimes push up rapidly or sell down rapidly, or like over here, because they have so much of our money in the market. Okay, so when it creates an imbalance and creates a deficiency in price to where they drive price up so hard that other buyers and sellers in the market are not able to put in their trades or their buy and sell orders. So like when we look here at recent price, they form an imbalance here, and that's what these gray lines mean, imbalances. And so what happens is there are sell orders that were not able to be filled out while they were buying up.
In other words, they need to fill up in the gaps.
Exactly. Thank you. Exactly. So what they need to do is they need to bring price back down, because see, there's an imbalance in this area. There's an imbalance here. There's an imbalance here, and pretty much all of here. So they're going to have to bring price back down in order to fill 50% of this balance, maybe even more, before continuing up. Because see, here's the thing. We have to think like the banks do. And really the banks are people who invest in the bank or make money in the bank with our money. They think just like us, right? So if you put in a buy here, right, and you buy price up so much, you're profiting from this. But there are sell orders you're not able to close. So even though you're profiting massively from here, but you're losing money off of this sell you didn't close. So the banks, you got to understand, when the banks are profiting, they're making billions or trillions of dollars. But when these sell orders are left open, they're also losing billions and trillions of dollars as well. So they have to come back and buy off those previous orders in order to break even, so they don't lose any money. So what does that mean for you and me as a person who is learning retail and getting consistent now wants to step up their game and bring the trade to the next level and understanding institutional? What that means is that the banks are going to either do two things. They're either going to bring price down to buy off this imbalance here, okay? Maybe possibly even bring it down here because price creating an imbalance right here. Or let me zoom out here. Or what they're going to do is they're going to decide to buy price up and fill these imbalances up here, create an all-time high, and then use all that sell momentum to fill all these imbalances here, down here. Okay, so either way, the question is which way they're going to go. Are they going to buy price up to fill these imbalances, or are they going to fill these imbalances first? That's the question. And that's the reason why when I identify this trend on step 2, I wait for a break and retest with the Delorean EMA extra confirmation. So that way, if I know for sure that price breaks and retest and is selling, then I could say to myself, well, I'm gonna jump in for a sell, because the banks have made their decision to go ahead and fill this imbalance. And since they have so much money in the market, they have the power to create a strong trend and push it this way. But if it breaks a retest and goes up this way, then I know it's going to be a strong buy up here, because they're going to fill these orders in to get their money back or to break even. Let me pause this recording. I got to answer a text real quick, and then I'm going to resume this recording. Be right back.
Okay.
Okay, so I'm back. So now, like I was saying before, we need to wait for that break and retest, because we know that the banks are going to either go this direction to fill in these imbalances, or this direction. It just depends on what they want to do. Once they made their decision, pretty much it's pretty much going to be a 90% chance you're going to be in a very strong trend and you're going to make money, versus trading the retail way, where you're trying to guess which way the market is going, and then you catch yourself in the reverse because you're trading against the bank and don't even know it. So that's why learning retail gets your foot in the door, but then learning the institutional side is where the money's at. So now that we did that, so then we located imbalances in the market. That's step 3. Step 4, that's when I go ahead and plan my trade. So what I do is I take my risk to reward and I set it. And then I set this as my first take profit and then my second take profit. So that way, if price breaks this, retests and sells, then I can click on here and enter in my stop loss and take profit to be in the trade. Or if I want to do a sell stop, then I got the entry price as well. But then I also take my risk reward tool and also plan up for a buy. Just in case the price decide to go that direction, then I'll be prepared. So then I can place it here. And this first imbalance here would be a take profit, and the second one would be, I'm sorry, the first imbalance here would be the first take profit, and then this would be the second one. Okay. And then I'll probably put like my stop loss maybe up to here. That way, if price break and retest and buys up, then I can click here and put in my stop loss and take profit. It's the lead, and it's right there for me. I could just paste it in my MetaTrader 4 and leave it there. Then when price confirms off of the EMA cross, that price is going that direction, and all I got to either hit is buy or sell, depending on where price is going. So now, once I do that, then I turn on, I'll probably move this up to here. So then I like to turn on the Delorean Ema Indicator. And this is how it works. So like you see here, when the yellow EMA crosses the red EMA, especially if it crosses all these other EMAs, it produces a very strong trend like it did here. But with the EMA, I use this as extra confirmation after I see what's the institutional structure. If this cross, if the yellow EMA and the red EMA cross lines up with all of the structure I drew up in the lines with everything, then I'm taking that trade. That's how I do that. I don't rely on indicators to always tell me when to buy and sell, because most indicators are very accurate, but they could be sometimes very inaccurate when it comes to institutional.
Yeah, because most of the markets, the way the signals work, it will actually bounce on and off to one number to another.
Right. Exactly. So one of the things I learned in our Tradenology Academy is that one of the things they teach is that when you see the last sell candle and price instantly goes up, then this is a liquidity point, which means that eventually they're going to have to come back down to this zone to medicate and fill all these orders. Okay, so that's why I'm going to put a zone here, even though there's one down here. Well, matter of fact, this is what I'm actually going to do. So I'm going to delete this, and actually I'm going to bring this zone right up here because it's close enough. I'll just bring this up to here, and I'll bring the zone up to here. As the price come down to here, then they're mitigating this imbalance, and I mean they're really mitigating the zone. So that's how you could draw. That's how you can draw that. And then another tip as well is like when you look at the last buy candle before price went down, this is another zone as well. So when you look at this zone here, and I want to ask everybody a question. This created an imbalance down here. Okay. So let's say I just go ahead and draw this zone across. Then I'm going to delete it. And then we're going to play the replay, see how price played out. But so again, here, the banks put in a buy here, but then price sold. So even though price sold, there was a lot of buy orders left open, and initially this one. So even though the banks made massive profit off of this sell, they still had buy orders that had to be bought off so they can actually break even. Now, do you see when they actually bought price back up to fill this imbalance all up in here? Yes, you do. Because one, they bought price back up to fill this imbalance from here to here. So you see it right here. They bought it back up to mitigate that before they actually sold some more down to this zone. But then ultimately they bought price all the way back up here to actually fill in this imbalance. Now, do you see that, Jared?
Yep.
So now you can kind of see what we're talking about when it comes to knowing trading imbalances. That's where the money is at, because you're not guessing on the possibility of where price is going to go. It's just a matter of, go ahead.
No, you're not guessing because you already got it labeled out. So you just need to watch, set up.
Right. Watch it set up and watch which way, and really ask yourself which imbalances are they going to finish first before going to the next one. So in this case, as we know, since I traded this morning, price ended up selling, which I ultimately figured it was, because this is the nearest imbalance. But I still wanted to make sure that I had a plan B just in case the price decided to buy up, and then I was able to buy with it. So since I know that price sold, and I did this early anyway, but I drew a trend line here. And so now we're going to see how price played out. And then what I'm going to do is I want to kind of actually show you what I profited. Matter of fact, let me pause this recording and see if I'm still able to share my phone screen. If not, then I'll probably show you got show on Facebook. Give me a second here. All right, so we're back. So ultimately I did this trade this morning live, and I actually have it recorded and put it on YouTube, but I'm going to play out on exactly how price went and how I made my money. So I'm going to play it one at a time, then I'm going to do a full replay. So price started pushing down. Matter of fact, I'm going to zoom in a little bit more. Can you see price a little bit more?
A little bit.
Can you see it now?
Yeah, I see it.
Okay. So I want to kind of play it now. So yeah, maybe that's better. So see how they kind of, this created a small imbalance candle, so they had to fill that in. Then ultimately it looked like price was buying up. Now, here's the thing. 9 times out of 10, like I mentioned before, when the yellow EMA crosses the, when the red, yellow EMA crosses the red EMA, it's probably a sign that price is probably going to buy up. But notice I said before, the structure has to line with everything. So when I see price, and this is what I'm learning, when I see price buy up like this, I don't automatically take the trade because price can still fake you out. And next candle close, the banker's candle can close below and start to sell. Next thing you know, you're in the negative. So sometimes, oftentimes, sometimes price can buy up and it may be hitting an order block and then it starts to retrace and pull back. So my rule of thumb is when price pushes up, I need to wait for the next candle. If price pushes back and retrace, I need to wait for the next candle to close above and then really, really buy up. Then I would have considered buying. And that's when I'm learning recently, that's how to go. And I'm going to show you guys in a minute. So most retail traders would have bought this. They said we're going to the moon, right? Because they're probably going to shoot price all the way up to the 70% and then make price overbought and then sell, right? So that's understandable from a retail standpoint of view. But when you understand the institutional, you understand that the banks could actually sell this because price is at an all-time high. So they like to sell high and make price boom. Okay. So you don't want to get caught in a fake out and then you end up in a huge drawdown or end up blowing your account. So I waited. I said, okay, price is going to buy up, but let me just wait and see. So then price bought up a little bit more. I said, okay, cool. Price pushed up, but I still waited. Then all of a sudden, price started showing signs of weak buying pressure with this wick. So now I might have to zoom out a little bit more so we can see everything. Can you still see everything, Jared?
Yes.
Okay. So price pushes up, it closes above. Now, realistically, I'm gonna be real with you guys. We could have bought this up and got a bag if we were trading NAS. But I was looking at the bigger picture. I said, I've made this mistake before. I'm not getting caught in a fake out. So I'm just gonna wait a little bit more. And then guess what? They would have faked us out. So if I would have took this buy trade, they would have faked me out. And so then price started pushing down. And guess what? The EMAs are almost crossing, but I didn't take the trade yet. Okay. Then price drops. And at this point, I kind of waited. I think I might have been in this trade already. Yeah, I think I went ahead and took the trade, even though it wasn't a full cross. But I said, it's going to head in that direction. I'm going to take a shot. And then I believe I jumped in this. I believe I jumped in this trade. Either I jumped in this trade and already made my money, or I actually jumped into this trade. I know what I did. So price closed below, and I said, you know what, forget it. Let me go ahead and take it. Price dropped. And then ultimately price dropped down to here. So I think I almost hit my first take profit. My first take profit was down here. So really, in reality, that gave me a good, decent bag in NAS. Okay. So price was bearish until it hit this point. Then they started to push up because they had to fill 50% of this imbalance. So I said, okay, they're going to fill this imbalance and pull it back, and then it's probably going to drop some more. So that was my first trade. I closed my first, I believe by this point, I closed my first partial trade, and then my second one, and then price went up. So then I'm gonna show you guys what price did after that. Then it dropped even more. And at this point, when it crossed here, I jumped in for a second trade and made money on my second trade right there. And I think at that point, I crushed my first take profit. I had to probably replay live again. And then at that point, I took my my first partial trade. The second trade was closed. I was done for the day because I made a decent profit. But I'm going to also play on exactly what price did. So what we're going to do is I'm going to start it back to here, and I'm going to play a full replay. Let me adjust it here. Let's play to see what price did. All right. Got in the second trade, then closed it. And look, dropped. came back, trying to mitigate that imbalance. And then it went for another round, drops, hit both my take profits, pull back a little bit, drops, pull back a little bit more, pull back a little bit more. And then for another round, that was another entry, went down. I want to say price did come back down again, because I thought it came down to this zone. Let me double check. Yeah, and see, they had to mitigate half of this area. So let me see. Well, here's the thing. Here's what we're going to say. I thought it actually went down to here, but it didn't. It actually went down to this point. I think I had a zone drawn here. So he's going to draw another zone here. So let's analyze this for a second. So let's see here. So you guys kind of see my point. So now when they went on ahead and sold this, right? There were some buy orders here that was left open. Same here. Okay. So when we look at even this last buy candle, like I talked about before, this created a zone that they had to mitigate. Well, guess what? They bought back 50% of that, which they had to close this buy. So let me actually drive this on home. So this is a good demand zone here. Okay. So here's realistically what you could probably do as your next move. Okay. So there's an imbalance from here, possibly to here, really all the way up until here. So they kind of did mitigate this area, but they mitigated this area based off of this here. So I'm going to draw another zone from here. Okay. Now, do you guys see them filling in all this imbalance that this created, right? They reversed price and bought it all the way back up to here. You see that, Jared? Let me know in the chat if you see what I'm talking about. So they brought it back up to here. Now they're going to probably fill this imbalance, and then they're going to buy price up to here to eventually fill this area. So if you wanted to, I don't advise this, but if an experienced trader could have short-term bought this up, made some money, probably bought it up again. And then when it hits here and it resists here, because they feel that this imbalance, they're going to sell it again. That's another sell opportunity. That's why trading imbalances are so powerful, because then it creates, opportunities for entries. And so that's probably what they're going to do. They're probably going to sell it down again. So if I want to get into another sell, then I'll probably wait for this cross and maybe just get a couple more pips here if I wanted to. But that's pretty much it. That's pretty much how I traded it this morning. You say your job called you. Okay. You there now, Jared, or?
Yeah, I'm back.
All right. So that's how I trade stuff now. Chris has been implementing similar stuff that I've been teaching him, and it's been working for him as a charm. So now what I'm going to do is actually show you what I profited. Share my phone screen here. I'm able to share my phone screen again, Chris. I figured it out. Thank goodness. All right. So notice I started with a very low lot size, very low. So 0.04, closed a partial, $57. Closed the second partial, 86 cents. Jumped in on that second time, 44 and an 8. So $110 profit that day. Now imagine if I had did $20 per pip. Then that would have probably been $200 to $250 profit there. And then little bit extra there, and then once again 250. That could have been a $500 day. But this is the results that you get when you trade institutional. It's a whole different ball game when you understand those imbalances and order blocks. Now, with this order block indicator, it also shows you order blocks as well. So I'm going to actually adjust some settings here. Then I'm going to turn off the recording just in case my computer acts stupid. So order block finder. So what I'm going to actually do is, let me do this. I'm going to actually clear all the things that I've drawn so far and just leave the imbalances up. And I'm going to turn this off. So now I'm going to turn on, let's see, will this come on? Yeah. So this, the reason why it's sold is kind of hard to see, but there's a red imbalance line, red line here that represents a red order block. So I'm going to actually highlight it. And I want to make it red. Okay. So it lets you know why price sold down so hard, because there was a red order block here. So notice notice previously, right? When price was pushing up and retail traders thinking, man, this thing gonna buy up, let's put in a buy. And the banks are like, nope, I'm gonna fake you out, make you lose money, cry to your mama, we selling, and then it's sold, right? Yeah. And then you have another sell order block even here, which made price even go down here, because you kind of see the red dot here. I wish I could make it more visible. So, but then I think we also see a buy order block here, which is why price went up. Okay. And that's why this is labeled buy. So that's why I like to use this indicator, because it's one time $7 and you're able to locate when the banks are buying and selling and trade with the banks instead of against them. So that's how I do it. And it's been consistent. That's why you got all these buy order blocks here, push price up, boom, 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 and then one right here, and then sell order block, you know, it's consistent. Because when you agree, you'll make more consistent money trading if you get in moves like these every single time, or most of the time.
Most of.
That's what these imbalances is going to help you catch. These big, big moves all day, every day. You know, so that's how we do it. So I'm gonna stop this recording. That's the end of this back testing session. We just do a little Q&A and just kind of clown. I know Chris is here. You there?